Hello and welcome to this week's episode for SPY Trader Now. I am your host. My name is Ken, and our model portfolio is up 13.38% year to date. And I've also now introduced a color strength signal so that we can see according to my version of the market strength is right now. And I'll go through in detail later on how I come up with this signal. But right now, the signal strength is yellow. So in other words, caution is advised. Red light stop, yellow light caution, green light go. And we compare ourselves here against the S&P 500 buy and hold investor. Their portfolio is up 17.73% year to date. So they've had one heck of a run over the last 2 weeks. Our goal is before the end of this year is to beat that return. But the strategy that I impose for this portfolio is challenged with the current environment, the way things are. The market is weaker, is not exactly a strong market, but the last 2 weeks have been very strong for the market. And I'll go into great detail what I think happened over the last couple of weeks and what I think is going to be happening in the future. Here we do a very simple portfolio. We have 3 positions, and it's basically similar to the one stock blueprint where we just trade the ETF symbol SPY. We buy the ETF in the shares, or we'll do options with the same ETF, or we're in cash. You can see exactly how we are currently invested on our portfolio. Here are some past returns. You can see over the last 3 years, we've had some very successful returns with this strategy. Last week, the S&P 500 gained 2.31%. These are candlesticks. These are weekly candlesticks, and this is going back 5 years. I'll go through the charts in much greater detail later on, but you can see over the last actually about 3 weeks, you can see how we've gone from this low here where we bottomed at about 410 and just jumped up to where we are now at 450.79. We are now at a resistance point, this resistance point right here. Then we have this resistance point slightly above that. Then we have the all-time high at this resistance point. So there's tons of reasons for this market to hit a wall and move sideways to down. Last week, we did make a trade on 11/13/23 where we rolled out our 2 in-the-money covered calls. Now, I didn't want to risk those calls getting exercised. I just want to hold them out now for now until the market comes down, softens, and then we buy to close them. We did get paid a nice credit of $3.05 when we rolled out those to December 15th. Here are some of the trades that we've made in 2023, and we have 2 current open trades. So we currently have 200 shares of the ETF SPY, and so the yellow symbol indicates that it's not a closed trade. These are the closing prices as of Friday, the last trading day's close. And we also have 2 in-the-money covered calls right here. If you want to learn more about me, you can head over to SPY Trader Now with this link right here. It'll be in the description down below. Go ahead and hit that subscribe button, ring that bell to be notified, and smash that like button down for me. Thank you. All right, here is the equity curve of our model portfolio. So we've done very well considering that you don't see a large drawdown throughout the calendar year so far. Here is the equity curve for the S&P 500 buy and hold investor. And here are the 2 equity curves combined. So our model portfolio in blue, our goal is to be above the pink, which is the buy and hold S&P 500. But over the last 3 weeks, they just had an unrelentless bull run that far surpassed my personal expectations. And I put my portfolio 2 weeks ago to profit if there was going to be softness in the market. There was not softness in the market. It went the other way. So we didn't lose money, but we also didn't make money. Now here is the Fed chair. His name is Jerome Powell. And here are how some of the interest rates, the latest ones, how the Fed has made their decision as of recently. The next announcement will be on December 13th. That'll be the last meeting for the FOMC for 2023. Then we have to roll the 2024's calendar. Are we going to have a 25 basis point rate hike or a skip? I'm hearing news going both ways. It's really not clear exactly the direction, what's going to happen. I think it's 50-50. Now we are looking at things from the presidential election cycle theory, which states, depending upon the year of the election, you have historical rates of return for the S&P 500 and for the NASDAQ 100, symbol QQQ. President Biden is in his third year in 2023. Historically, that averages 16.3% for the S&P 500. Currently, the S&P 500 buy and hold investor is up 17.73%, allowing room for this market to come down and soften and still be within the historical normal average. Now we're looking at things from the bond market outlook. And the bond market is saying to stay out of the stock market because we have an inverted yield curve and we have rising interest rates. So we're waiting for this yield curve to normalize so that these shorter term yields are lower than the longer term yields, but it has not happened yet. Now we are looking at things from a valuation standpoint, and I've got two different valuation entities that I'm reaching out to. So the first one is current market valuation, CMV, link here and in the description down below. They are saying that the market is overvalued by 39.3% for the price per earnings ratio compared to the historical norm. And that puts it on a chart of 1.0 standard deviations. So we're overvalued, there's risk in this market according to CMV. Now, another entity that does stock market analysis, and their link here, vectorvest.com, and I'll have it in the description down below. Everything, all the links will be down in the description if you want to explore anything. And they have a current buy recommendation for symbol SPY. They say that the value is on par, it's at value right now, that the timing is very good. I disagree that the timing is good today, and I'll show you why later on in this presentation, and that the safety for this position is fair. From in my viewpoint, the timing is not the time to go long with more positions of SPY. We already have a in the money covered call position, but we're only going to make good profit if the stock market comes down with that, and I'll show you that exactly why later on. Now we are looking at CNN Business Fear and Greed Index. Here is our friend Warren Buffett, and we are at greed. 1 week ago, we were at fear. We were over here at fear. We skipped over neutral and went directly to greed. And that's where we stand right now. Now we are looking at things from a seasonality outlook. This graph on the right is the seasonality graph for symbol SPY going back a total of 20 years. Historically, in the month of November, our current month, there is an 80% probability that we are going to close the month higher than when we opened the month. But look at the month of November. We are up 7.79% in 1 month. This is an incredible month for the S&P 500. Now we are looking at things from Almanac Trader, and we are going back many, many years here for what's happening. You've got the recent years of 2022, 2021, and the pre-election years, 1950 to 2019. So we're going to be focusing on the pre-election years because currently we're in a pre-election year. So this dashed green line is the line that we want to focus in on for our purposes today. Now, here we are, and today is November 18th, so we're just after the last trading day of the 17th. Historically, going back to 1950, the next week of trading historically shows weakness in the market. Then it bottoms sometime around after Thanksgiving and then pops from there. So we're looking to see what this weakness is going to entail. We are due for some weakness because it's been so strong for the last 3 weeks. Now we are looking at a long-term outlook. This is a chart, monthly chart, going back for 20 years for the S&P 500. There's your bull run from 2009 all the way to 2022. You can see how strong the market is. We are still in a bull run as long as we stay above this line here, because it's acting as support off of these 2 touch points. And when we corrected down, we broke out above this resistance line, have not looked back since. As long as that maintains, and currently that is absolutely maintaining, we are in a bull market. Also, look at the MACD. The MACD started to go towards its signal line, did not touch it, and the distance between the MACD and the signal line is increasing. All of this suggests that the market is in a bullish configuration for higher prices in the future. Now we're looking at things from an intermediate term outlook. Weekly, going back 5 years, candlestick chart. Here in the thumbnail, you can see the last 3 weeks, very, very bullish action. But now we're hitting some resistance from this old high here. Then we have this high here to contend with. Then the all-time high right there. MACD still has not crossed above its signal line, but this is actually looking very positive and bullish. Histogram going this way, getting ready to cross above the 0 line. So this is actually bullishly configured for higher prices. Looking at the slow stochastics and the MACD, it's these resistance points that give me pause to suggest that we're going to be hitting either some type of sideways movement or downwards movement over the next week or 2. Now this is a daily chart going back 6 months, candlestick S&P 500. You can see the nice run that we've had. We're in this trading channel right now, and this is the angle of ascent of this channel is unsustainable. We cannot maintain this angle of ascent for long periods and durations of time. It's too steep. So this is going to come down and correct to at least something. Here you had that angle of ascent, then you had a pullback, then it jumped out above it. So are we going to experience one of these legs right here? I don't know. But I know that this angle can't ascend in a straight line like that continuously. There's that resistance touch point right there. We'll see what happens once we get to it, and we are almost there. Now we're looking at the ratio chart for the NASDAQ 100 to the S&P 500. The ratio chart is in black and red. Now normally you want the NASDAQ, which is your tech, and to be leading the S&P 500 for a nice bull market. But what's happening is the ratio chart is showing that it is losing momentum, meaning that the S&P is beginning to outperform the NASDAQ 100. Now, from an overall market strength outlook, that's not a good sign. Your MACD here has topped, getting ready to cross below its signal line. Again, telling you that the NASDAQ has some room to fall, meaning that we're going to be starting to go to a risk-off market once this configuration does happen. And it looks like it's setting up for that to happen. Now we're looking at another ratio chart, but this one is the equally weighted S&P 500, symbol RSP, to the normally weighted S&P 500. The ratio chart is in black and red. The lime green is the equally weighted. The dark blue is the normally weighted S&P 500. The ratio chart has fallen off of a cliff 3 times in the last 20 years. The last 2 times it's done this, it's had sideways action after falling off of a cliff before jumping back up and then resuming and going north. Here it jumped back up and head north. Nice bull run, nice bull run. The problem is that in the past 20 years, the past 2 times that we've fallen off of a cliff on the ratio chart, well, the S&P and the equally weighted both have fallen off of a cliff. That did not happen in 2023. They are still way, way up here, which is concerning. Is this shoe left to drop? And if so, when is that going to happen? And if it's going to happen during the time it does this bouncing around. If we start to come back up, like we did here and here, well, then that's going to be an indication that the bad news is behind us and good times are ahead of us. But we're not there yet. We still have some sideways action to take place if we're going to maintain what we've seen in the past. Also, MACD is not going above its signal line. These are bearish configurations. So the MACD has dropped down here and here twice. We've dropped down here once, and it looks like we're going back for a second touch before it comes back up. Now we are looking at the VIX, which is the volatility index or the fear index. There are 3 ranges that I have identified. You've got the ultra low range, the low range, and then a higher range. And right now we're trading in the ultra low range. And right now the MACD is showing that it wants to push higher. The MACD here looks like it might be losing a little bit of steam. The histogram is clearly going higher. So if this were to start to pop up, well, the S&P 500 is going to start to come down. So that certainly is set up for it to very easily happen. The histogram is the first warning shot or the first sign to give you that indication that the VIX is getting ready to pop back up. Now we are looking at the Think or Swim platform for the S&P 500 symbol, SPY. That's most of all of our charts. And here we've got standard deviations. Here's a little bit about standard deviations in case you don't know about them. The gold lines are the +2 and -2. The pink is the +1 and -1. This pink line, wavy line here, is the 100-day moving average simple. And here the green line is the 50-day simple moving average, and the black is the 200-day simple moving average. On the 1-year chart, the standard deviations are traveling north when you look at the left-hand side of the chart compared to the right-hand side of the chart. That's bullish over a 1-year time frame, telling me that if we buy in today, 1 year from now, there's a high probability that we are going to have prices higher than where we purchase right now on a 1-year time frame. Right now, the S&P 500 is trading right at the regression line, which is this dashed green line, which is the midway point between all the standard deviation lines. So on a standard deviation, we're currently trading at 0.0. It's right at the regression line. Now we're looking at the same chart, but instead of going back 1 year, we're only going back 6 months. Look at your standard deviation lines. They are flat as a pancake, telling me that if we buy into the market today, in 6 months from now, we are going to be at approximately the same position that where we are at right now. We are not going to make money according to this chart. That can, of course, change. This is from the data that we have with us today. And we're at the upper range of this flat standard deviation chart, like we were here, and then we saw softening, like we were here, and then we saw softening here at the regression line, and we saw softening down to the -2. These are your buy points, these are your sell points. Now we're looking at the same chart, but this time we're going back 3 months. Only 3 months of data here. And as you shorten the time frame out, your data becomes not as accurate as when you go to the longer term time frames. So you got to keep that in mind. Now, we do have a negative sloping standard deviations on the 3-month chart. Where's the S&P 500 on this chart? It is up here at above the +2, +2.1. there is a 95% probability that within the next 3 months that the S&P 500 is going to be lower than where it is right now. Based off of this probability is how I am placing my trades. So that is why I have in the money covered calls, because I have an expectation for the market to drop. Keep in mind, it's only a 95% probability. It is possible that the market will ignore the probabilities and continue to advance. But from a statistical standpoint, which is how I trade, it is more likely to drop rather than advance, at least giving time for this standard deviations to change. Now, I've introduced a new data into my presentation where I'm doing an overall market strength. This chart, this is an Excel spreadsheet broken up into 2 sections. This section over here just deals with asset classes, and I'll go through that in a second. Now, for our purposes, we're only dealing with one. For this portfolio that I'm presenting to you for our trading, for this presentation, we're only concerned with one asset class, and that is the equities of the S&P 500. That's why these 11 sectors are critical for our strength of the S&P 500. So we have the sectors broken down here individually so we can get the sector strength. And if we just want to look at the overall strength of the S&P 500 as an asset class, I've got those numbers right here. And what are those numbers, and then how do we derive at those numbers? So for the first column, as an example, for the S&P 500, we're going to take the slope of the 50-day simple moving average for the last 20 trading days. We're going to take that, and if it's a 0, if it is negative, 1 if it is flat or within 1% of its current number, and we'll put the number 2 in if the slope is positive. So this cell here has the ability of going from 0 to 2. This cell over here tells you whether you're trading above or below the 50-day simple moving average. And it's very simple. 0 for no, 1 for yes. So you can go up to the maximum number of 1 in this column. In this column here, you have the slope of the standard deviation on the 3-month chart. 0 for negative, 1 is flat or within 1% of the 3-month chart, and 2 for positive. So you have the ability to go up to 2. So the maximum number that you can derive at here for the asset class strength is 5. Right now there's only one asset class that is giving you that number, and that is gold, symbol GLD. So that particular symbol is the strongest of the asset classes out of all of these asset classes. And we're looking at different things here. We're looking at precious metals, bonds, emerging markets, world markets, excluding the United States. Plus, up here we have the United States broken up into 3 categories: large cap, technology, and small cap. So we have everything covered pretty much to give us a good view of how the world is doing in the world of asset classes, and down here specifically how the 11 sectors of the S&P 500 are doing. Now, when you take, and the maximum number that you can get here is going to be 100%. Now, when you look at that, we have to determine, okay, we want to translate this into our color guard. Well, our color guard is going to give us, if it's between 0 and 25%, it's going to be red. If it's between 26% and 50%, it's going to be yellow. Currently, we're at 33%. That is why we are yellow. If it is between 51% and 100%, it's green. And then that's the signal you would have. Then you may say, well, how come you derived at this? You've got to understand that the S&P 500, generally speaking, on any given day, has a 75% probability that it is going to go higher rather than lower. So the scale truly isn't from 0 to 100%. It's from 0 to 75%, with 75% being 100%. So we are definitely skewed towards giving the S&P 500 the edge, or we're going into this thinking, knowing that under a normal market condition, you're going to have higher prices rather than lower prices. But this does still give us a good overall strength of how the market is doing. Now, with the market being 33% with all of this data and based off of 11 sectors, by the way, if you look over here at your sector strength, there's only 2 of the 11 sectors that are carrying this market. The technology sector, symbol XLK, and the communication sector, symbol XLC. The rest are not doing so good. Some of them have zeros. So that's why there's definitely caution in this market. And the rally that we have just experienced in the last 3 weeks is not from the position of having a strong stock market. This is not yet anyways. This may turn into a strong stock market, and those numbers will reflect here, and you will see a number greater than 50% in at least this one here, and of course this one over here for the S&P 500. So, but basically this number here is the derivative of all of these sectors combined anyways. So that is where we stand, and that is how I came up with this yellow, and we're going to keep this on and monitor this on a weekly basis so we can see how well different asset classes are doing and how well the specific 11 sectors of the S&P 500 are doing. Now we're looking at Treasury yields, 10-year U.S. Treasury yields. And the S&P 500 is in blue. Treasury yields are here in the candlestick format. You can see the MACD on the Treasury yields has come down. We're below the zero line. The histogram has started to come up. This is ripe for a turnaround and to come up. And I see that gap right there. I think that gap is going to get filled. When that happens, this S&P 500 is going to correct down. We have a holiday coming up. We have Thanksgiving. The market will be closed observing November 23rd off. I have just given you a ton of information in this presentation. What are you going to do with that information? Here comes your critical thinking. Well, as of November 18th, 2023, the market summation, according to me, Ken, your host with Spy Trader Now, on Friday, 11/23/23, I rolled out my in-the-money covered calls. I got that credit, $3.05, because I'm expecting some downward to sideways action over the next week or so. The only way I can make money in a downward to sideways action is by selling options, and that way, by selling options, I can get time premium. If on a sideways market. If there's a downward market and it's going to stay downward, I could buy puts. I could buy them outright. But in this market, with it being so strong, I don't have the confidence to buy puts. I bet you I could buy long-term puts going out 2 years and I could make money. But I'm waiting for this market to soften up somewhat before I even want to start going in that direction. And we haven't seen that. The last 3 weeks have been extremely strong. So the market rally over the last 2 weeks, that really should say 3, has been a short squeeze, and it's been remarkable. We do want to go long, even though we have a yellow signal according to our strength signal. But we don't want to enter more longs at this level because I think we're overvalued. My plan is to buy to close my covered call positions when SPY reaches some level of support, looking at the 3-month chart at the regression line or below. That's the midway point on the standard deviations or below that. And I explained that here. The regression line is that dashed green line on the standard deviation chart. You can go back in the video. You can look at that again if you want to. I am still concerned about this market until that slope of the 50-day simple moving average is at least flat or positive over a 20 trading day time frame, and we're trading above the 50. We're in a good position with our current portfolio. We are holding $18,000 in cash in the model portfolio. We're not fully invested. We have cash to make position changes if the need arises, but I'm waiting for that need to arise, which has not happened yet. So that's it. I hope you got some valuable information out of this video. If you have not done so already, help me. Smash that like button down for me right now. Subscribe to my channel if you want to see how I do this week by week. I post one video per week. Ring that bell to be notified when I post a new video. I thank you, and I wish you good trading.